The markets closed Friday afternoon and most investors went home thinking about their weekend plans. But in the trading floors of Lower Manhattan, in the quiet offices of institutional money managers, in the risk management departments of the largest banks on Wall Street, a different conversation was taking place. A conversation about what just happened to Nvidia, and more importantly, what it means for the $100 trillion sitting in global equity markets right now. On January 31st, reports surfaced that Nvidia's planned $100 billion investment in OpenAI had stalled. Not delayed, not postponed, stalled. The financial press buried the story beneath headlines about Federal Reserve appointments and precious metals volatility, but the people who manage serious money, the people who move markets, they noticed. Because when the largest technology company in artificial intelligence suddenly stops writing checks to the most valuable artificial intelligence company in the world, that is not noise, that is signal. For 18 months, the investment thesis behind technology stocks has rested on a single pillar. Artificial intelligence will transform everything. Companies will spend whatever it takes to build AI infrastructure. And the companies selling the chips, the cloud computing, the software platforms, they will capture that spending and turn it into unprecedented profits. The math seemed simple. Spend billions today, earn trillions tomorrow. Nvidia became a $4 trillion company on this promise. Microsoft, Amazon, Google, Meta, they all became larger, more valuable, more dominant based on this same calculation. The AI revolution justified every valuation, multiple, every capital expenditure increase, every ambitious earnings projection. But something changed this week. The stalling of Nvidia's OpenAI investment is not an isolated event. It is a symptom of a larger structural problem that the market has been avoiding for months. The artificial intelligence spending boom is reaching its natural limits, not because the technology does not work, but because the financial returns are not materializing fast enough to justify the scale of investment. When you strip away the excitement, when you remove the narrative, when you focus only on the mathematics, a different picture emerges. And that picture looks uncomfortably similar to another technology boom that ended badly. Between 1995 and 2000, investors poured money into internet companies. The promise was identical to today. New technology would transform everything. Companies needed to invest heavily to capture market share. Profits would come later once dominance was established. Stock prices climbed higher and higher, detached from current earnings, justified entirely by future potential. Then the music stopped, not all at once, but gradually, then suddenly. First one company missed earnings, then another announced slower than expected revenue growth, then capital markets tightened, then the entire structure collapsed, trillions of dollars in market value evaporated, retirement accounts were destroyed, careers ended, and the investors who saw it coming, who recognized the pattern, who understood the mathematics underneath the hype, they survived. The ones who believed the story until the very end did not. The flow of money does not operate on belief. It operates on incentives, on constraints, on the mathematical realities that govern capital allocation. And right now, the mathematics of the artificial intelligence boom are breaking down. The companies spending the most on AI infrastructure are not generating corresponding returns. The revenue growth is solid but not explosive. The profit margins are good but not revolutionary. And the gap between what is being spent and what is being earned is widening, not narrowing. This is not sustainable. It never has been. The only question was when the market would recognize this fact. This week it started to. Let us walk through the mechanics. Nvidia is not a speculative startup. It is a mature, profitable, extraordinarily well-managed semiconductor company with decades of operational history. When Nvidia announces a $100 billion investment in OpenAI and then that investment stalls, it sends a very specific message to the market. It says that even the companies at the center of the AI boom, the companies with the deepest knowledge of the technology and the most to gain from its success, are becoming cautious about deploying capital at this scale. If Nvidia is hesitating, what does that tell you about the certainty of future returns? OpenAI itself is valued at $500 billion. That valuation assumes not just success but dominance. It assumes that generative AI models will generate revenue streams large enough to justify a valuation higher than most of the largest companies on Earth. But here is the problem. The revenue is not there yet. The business model is still being figured out. The path from impressive technology demonstration to sustainable, profitable business remains unclear. And if that path is unclear to OpenAI, if it is unclear to Nvidia, if it is unclear to Microsoft, which owns 27% of OpenAI, then it should be unclear to every retail investor holding technology stocks in their retirement account right now. The spending has been extraordinary. Microsoft disclosed that it spent nearly $35 billion on AI infrastructure in the 3 months ending September 2025. Alphabet, Amazon, Meta, Oracle, they are all spending at similar scales. The combined capital expenditure from the largest technology companies is projected to reach $440 billion in 2026. This is not incremental investment. This is the construction of an entirely new layer of digital infrastructure, data centers the size of small cities, electricity consumption that rivals entire nations, supply chains for semiconductors, for cooling systems, for fiber optic networks, all being built simultaneously at unprecedented speed and cost. The justification for this spending is that it will generate future profits, but the future keeps moving further away. In 2023, the promise was that AI would revolutionize productivity within 12 months. In 2024, the timeline extended to 18 months. Now in 2026, analysts speak about benefits materializing in 2027 or 2028. The goalposts keep shifting, and while the goalposts shift, the spending continues. At some point, the market demands proof. It demands revenue. It demands profits that justify the scale of investment. That moment is arriving. There is a report from MIT Media Lab that most investors have not read. It states that despite $30 to $40 billion in enterprise investment into generative AI, 95% of organizations are getting zero return. Not low return, zero return. The technology is impressive in demonstrations. It generates excitement in boardrooms. But translating that excitement into measurable financial improvement has proven far more difficult than anticipated. Companies are discovering that integrating AI into existing workflows is expensive, time-consuming, and often delivers marginal benefits compared to the cost. This is not the story the market wants to hear, but it is the story the data is telling. Now layer on top of this the earnings season that begins this week. Over 100 S&P 500 companies will report results. The market will be watching for any sign that AI spending is translating into revenue growth. Disney, AMD, Alphabet, Amazon, Palantir, each of these companies has bet heavily on artificial intelligence. Each has made promises to investors about future returns, and each will now need to deliver numbers that justify those promises. If the numbers disappoint, if revenue growth slows, if profit margins compress, if management sounds uncertain about the timeline for returns, the market will react. And in an environment where valuations are stretched, where concentration is extreme, where investor sentiment is fragile, that reaction will not be gentle. Consider Palantir specifically. The stock has risen 2,700% since the beginning of 2023. 2,700%. The company is now valued at 177 times forward earnings. To justify that valuation, revenue growth would need to be accelerating dramatically. But revenue has grown 104% over the same period that the stock rose 2,700%. The mathematics do not align. The stock price is not rising because the business is growing at an extraordinary rate. The stock price is rising because investors believe it will grow at an extraordinary rate in the future. This is speculation, not investment. And when speculation is this extreme, when valuations are this detached from current fundamentals, the market becomes exceptionally vulnerable to disappointment. Wall Street analysts project that Palantir revenue growth will slow to 42% in 2026. 42% is still strong growth, but it is not strong enough to justify a 177 multiple. When a stock is priced for perfection and the company delivers anything less, the repricing can be violent. One earnings report where guidance disappoints, one quarter where a major contract is delayed, one executive comment about uncertainty in the AI spending environment. Any of these events could trigger a cascade of selling that takes the stock down 30, 40, 50% in a matter of days. This is not prediction, this is pattern recognition. It is what happens to every stock trading at these valuation levels when the narrative breaks. The concentration risk in the market makes this even more dangerous. The Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, represent 30% of the S&P 500, 30%. This is the highest concentration in the index in 50 years. When a small number of stocks account for such a large portion of index value, the entire market becomes dependent on their continued performance. If these stocks falter, the index falls. If the index falls, algorithmic trading systems trigger automatic selling. If automatic selling accelerates, margin calls force additional liquidation. The feedback loop becomes self-reinforcing. And because so many investors are concentrated in index funds, in ETFs that mechanically track the S&P 500, they have no way to exit without selling the very stocks that are falling. This is the structure of a liquidation event. The timing of Nvidia's stalled OpenAI investment is particularly significant because it comes at the exact moment when the market needs confidence. The Federal Reserve has a new chairman incoming. Kevin Warsh will take over in May. Interest rate policy is uncertain. Inflation remains above target. Economic growth is slowing. Trade tensions are rising. Geopolitical risks are elevated. In this environment, technology stocks have been the one area where investors still felt confident. The belief that AI would drive the next decade of growth has sustained valuations even as other sectors struggled, But if that belief erodes, if the largest and most knowledgeable players in the AI ecosystem start pulling back, then the foundation of the entire rally comes into question. Let us talk about what happens operationally when large technology companies reduce capital expenditure. First, the semiconductor companies feel it immediately. Nvidia, AMD, Broadcom, these companies have seen explosive revenue growth because cloud providers and AI companies are buying chips as fast as they can be produced. If that demand slows, if hyperscalers decide they have built enough infrastructure for now, if they shift from aggressive expansion to optimization of existing capacity, then semiconductor revenue growth decelerates. When semiconductor revenue growth decelerates, the stocks reprice. When Nvidia reprices lower, it takes the Nasdaq with it. This is mechanical. This is how the system works. Second, the companies providing cloud infrastructure start to see utilization rates matter more than capacity expansion. For the past 2 years, the race has been to build data centers faster than competitors. Utilization rates were secondary. The assumption was that demand would always exceed supply. But if enterprise customers are not seeing returns from AI, if they start to question whether they need to spend more on cloud AI services, then utilization becomes the critical metric. And if utilization disappoints, if the massive data centers being built right now sit partially empty, then the return on invested capital collapses. Investors will demand answers, stock prices will adjust accordingly. Third, the narrative around productivity gains starts to unravel. The entire justification for AI spending has been that it will make workers more productive, that it will reduce costs, that it will create entirely new revenue streams. But the MIT study showing 95% of companies getting zero return contradicts this narrative. If productivity gains are not materializing, if cost savings are not appearing, if new revenue streams are not developing, then what exactly is being purchased with these billions of dollars of capital expenditure? The market will eventually ask this question, and when it does, the answers will determine which companies survive and which do not. There is a deeper issue that connects to the structure of modern markets. A huge portion of the AI spending is circular. Microsoft invests in OpenAI. OpenAI spends that money on cloud computing from Microsoft Azure. Nvidia sells chips to Microsoft. Microsoft uses those chips to build AI services. OpenAI uses those services. The cash is flowing in a loop between a small number of large companies. This creates the appearance of a thriving ecosystem. But it is fundamentally different from a traditional economic expansion where money flows from companies to consumers to different companies. In a circular flow, if one participant stops spending, the entire system contracts. And that is the risk right now. If Nvidia stops investing in OpenAI, if Microsoft reduces its capital commitment, if any of the major players decides the returns are not justifying the costs, the loop breaks. And when the loop breaks, the illusion of infinite demand disappears. The market has seen this before. In the late 1990s, telecommunications companies spent billions building fiber optic networks. Equipment manufacturers sold billions of dollars of routers and switches. Investment banks financed billions in debt. Stock prices soared. The thesis was that internet traffic would grow exponentially forever and the companies with the largest networks would capture that growth. Then in 2001, the telecommunications companies realized they had overbuilt. Capacity far exceeded demand. The equipment orders stopped. The debt could not be serviced. Companies went bankrupt. Stocks that had been trading at 50 times revenue fell 90%. The investors who recognized the pattern early, who understood that capital expenditure growth was unsustainable, they sold and protected their capital. The investors who believed the story until the end lost everything. The parallel to today is not perfect. The technology is different. The companies are more profitable. The balance sheets are stronger. But the fundamental dynamic is the same. Massive capital expenditure based on future growth assumptions that may not materialize. Valuation multiples that require perfection. Market concentration that amplifies risk. And a growing disconnect between spending and returns. These are the conditions that precede corrections. Not small corrections. Large, painful, wealth-destroying corrections. Now let us examine the incentives of the major players. Nvidia has every reason to continue promoting AI. Their business depends on it. They sell the chips that power AI infrastructure. If AI spending slows, their revenue growth slows. So when Nvidia's investment in OpenAI stalls, that is a signal that even the company with the most to gain from continued AI expansion is becoming cautious. That is meaningful. That is not a company trying to talk down their own market. That is a company making a rational capital allocation decision based on information the public does not have. Microsoft is in a similar position. They own 27% of OpenAI. They provide the cloud infrastructure for AI workloads. They are integrating AI into every product they sell. They need AI to succeed. And yet, even Microsoft is starting to face questions about return on investment. In October, the company reported revenue growth of 18% and net income growth of 12%. Solid numbers. But the stock fell 4% in after-hours trading because investors were concerned about the cost of sustaining AI growth. If Microsoft, with all its resources and market power, is facing skepticism about AI returns, what does that mean for smaller companies making similar bets? Amazon, Google, Meta, they all face the same calculation. They are spending tens of billions on AI infrastructure. They are promising investors that this spending will drive future growth, but the immediate results are not matching the scale of investment. Amazon's cloud business is slowing. Google's search advertising growth is moderating. Meta's Reality Labs division continues to burn billions with uncertain prospects. At some point, these companies will need to show that AI is generating profits, not just revenue, and if they cannot show that, the market will stop rewarding the spending and start punishing it. The institutional investors, the pension funds, the sovereign wealth funds, the hedge funds, they are watching all of this closely. They are not making investment decisions based on excitement about technology. They are making decisions based on return on capital. And right now, the return on capital from AI investments is questionable. The smart money is already rotating, not out of technology entirely, but out of the most expensive, most speculative, most vulnerable names. They are moving toward companies with proven business models, sustainable cash flows, reasonable valuations. This rotation has been happening quietly for months, but it is accelerating, and when the smart money moves, the retail money eventually follows. The question is whether retail investors will recognize the shift before or after their portfolios decline. There is a behavioral dynamic at work here that makes corrections particularly severe. When markets are rising, investors develop conviction. They believe the rally will continue. They ignore warning signs. They dismiss concerns as pessimism. Then something breaks. A major company disappoints. A key assumption proves wrong. And suddenly all the concerns that were ignored become impossible to dismiss. Conviction turns to doubt. Doubt turns to fear. Fear turns to panic. And panic generates selling that feeds on itself. This is not irrational behavior. This is how human psychology interacts with market structure. And it is why corrections, when they come, are often faster and more violent than anyone expects. The Nvidia OpenAI news is the kind of event that can shift sentiment. It is not definitive proof that the AI boom is over, but it is evidence that the largest players are becoming more cautious. And caution is contagious. If Nvidia is slowing investment, other companies will ask whether they should do the same. If institutional investors start rotating out of AI stocks, algorithmic systems will detect the shift and accelerate it. If earnings reports this week show any softness in AI-related revenue, the narrative will crack. And once a narrative cracks, it is very difficult to repair. The broader market environment makes this more dangerous. The S&P 500 is trading at a forward price-to-earnings ratio of 22.2. That is the second highest valuation in 40 years. The only time it has been higher was during the dot-com bubble and briefly during COVID. Both times the market subsequently fell. Now, high valuations alone do not cause crashes. Markets can stay expensive for years. But high valuations combined with deteriorating fundamentals, that is when corrections happen. And right now the fundamentals are deteriorating. Economic growth is slowing. Corporate profit margins are compressing. Consumer spending is weakening. The labor market is softening. Interest rates remain elevated, and the one area that has been holding the market up, technology spending driven by AI, is showing signs of fatigue. The algorithmic trading systems that dominate modern markets do not care about narratives, they care about flows. When capital starts exiting a sector, the algorithms detect it and amplify it. The systems are programmed to cut risk when volatility rises, and volatility has been rising. The VIX, the market's fear gauge, has been trending higher, not dramatically, but steadily. This is a warning sign that market participants are becoming nervous, and when nervousness turns to fear, when selling accelerates, the algorithms do not hesitate. They execute, they dump positions, they liquidate exposure, and they do not care whether the selling is creating bargains. They care about following their risk parameters. This is why modern market corrections are so fast. The machines amplify human behavior. They make moves more extreme. They turn corrections into routes. Now consider the position of the average investor. They have been told for 2 years that AI is the future. They have been told to buy technology stocks. They have been told that missing out on AI is the biggest risk. So they bought. They allocated retirement savings to tech-heavy index funds. They purchased shares of Nvidia, Microsoft, Palantir. They believed the story, and now the story is beginning to show cracks. But they are not professional traders. They do not have access to real-time risk management systems. They do not spend their days monitoring capital flows and institutional positioning. They will be the last to know when the shift happens. And by the time they know, by the time the news reaches them through mainstream financial media, the damage will already be done. This is how wealth transfers happen, from those who react slowly to those who positioned early. The question every investor should be asking is simple. If Nvidia, the company that knows more about AI infrastructure than almost anyone, is hesitating to deploy $100 billion into OpenAI, why should I be confident deploying my capital into AI-exposed stocks? What do I know that Nvidia does not? What information do I have that they lack? The answer obviously is nothing. The retail investor has less information, less expertise, less ability to evaluate the true prospects of AI companies. And yet, the retail investor is being encouraged to maintain exposure, to stay invested, to believe in the long-term story. This is not advice. This is sales. And the people giving that advice are often the same people who need retail investors to keep buying so that institutional investors can sell. The path forward from here is uncertain. The market could stabilize. Earnings reports this week could exceed expectations. Companies could provide guidance that reassures investors. The AI spending boom could resume. All of that is possible. But the probability of those outcomes has declined. The stalling of Nvidia's OpenAI investment has shifted the risk-reward calculus. It has introduced doubt where there was previously confidence. And in markets, doubt spreads faster than confidence builds. Once investors start questioning the AI narrative, once they start demanding proof of returns rather than accepting promises of future growth, the entire structure of technology stock valuations comes under pressure. What should a rational investor do in this environment? The answer depends on time horizon, risk tolerance, and existing exposure. But the principles are universal. When valuations are extended, when concentration is extreme, when narratives are cracking, when the smart money is rotating, the prudent response is to reduce risk. Not eliminate it, not panic, but reduce it. Take profits in positions that have appreciated dramatically. Rebalance portfolios away from the most expensive sectors. Increase allocation to cash, to defensive stocks, to assets that perform well when growth slows. These are not exciting actions, but they are the actions that preserve capital during corrections. And preserving capital during corrections is what allows you to deploy it during recoveries. The investors who survive major market dislocations are not the ones who predict the exact timing. They are the ones who recognize when risk is elevated and adjust accordingly. They do not wait for confirmation. They do not need the market to tell them they were right. They simply protect what they have built. They understand that missing the last 10% of a rally is acceptable, but suffering a 40% drawdown is not. The mathematics of loss are brutal. A 50% decline requires a 100% gain just to break even. The further you fall, the harder it becomes to recover. This is why risk management matters more than return maximization during late cycle environments. And make no mistake, we are late cycle. The expansion has been long, valuations are high, warning signs are appearing, the music is still playing, but the exits are getting crowded. The story of Nvidia and OpenAI will continue to develop, more information will emerge, management will provide statements, analysts will offer opinions, but the essential fact will not change. The largest player in AI infrastructure has become cautious about deploying capital at the scale previously anticipated. That fact, combined with stretched valuations, elevated concentration, questionable returns, and a challenging macroeconomic environment, creates a setup that favors caution over aggression. It favors preservation over speculation. It favors those who understand that in markets, what goes up does not always continue going up. Sometimes it goes down, and when it goes down from elevated levels, it goes down fast. The question that actually matters is not whether the AI boom will eventually deliver the promised returns. Over a long enough time horizon, transformative technologies usually do create value. The question is whether current stock prices already reflect more optimism than the near-term reality can support, and whether investors holding those stocks at these prices will be forced to endure a painful repricing before the long-term vision materializes. History suggests they will. Mathematics suggests they will. Market structure suggests they will. The only real question is when.